Hello and welcome to our discussion today. Today we are looking at strategy formulation and strategic alternatives. And by the end of this class, you should be able to describe the concept of strategy formulation in business management. You should be able to identify some corporate strategies, analyze the Ansoff matrix, and examine Porter's generic strategies and their applications in competitive environments. So this will be the focus of our discussion today. So if we say strategy formulation, it is basically the process of defining an organization's direction and deciding on the appropriate actions to achieve its goals. We said this, I think, in our first session, all right, that without strategy, there won't be differences in how various organizations operate. It is the strategies that bring out the differences in all the businesses we see around us. So the process of defining the organization's direction and deciding on the appropriate actions to achieve its goals are what we refer to as strategy formulation. And this helps businesses to maintain competitive advantage. All right. It helps them to adapt to changes in the market. And then it also helps to drive long-term success. So strategy formulation is very, very important for businesses. Okay. So we looked at three levels of strategies. We spoke about the corporate level strategies, the business level strategies, and then the functional level strategies. And we said the corporate level strategies focus on the organization as a whole and define its competitive position in the market, right? So corporate level strategies are the highest. So within the organization, it comprises of all aspects of the organization. The first point here says it's the highest level management develops in considering its overall growth and opportunities in the future, right? The orientation and direction of the enterprise in the long run and overall boundaries act as the basis for formulating the company's middle and low level strategies. So we have the business level strategies and then the functional level strategies. These two depend on the corporate level strategy. So the corporate level strategy forms the basis or it forms the foundation for formulating business level strategies as well as functional level strategies. While formulating corporate level strategies, the company's available resources and environmental factors are kept in mind. We have spoken about the organization's resources and we have also looked at the environmental factors, both internal and external. If you have no idea what we are referring about, you can refer to our lectures on the internal and external environments, okay, as well as the resource-based view of a firm. That will help you understand this better. But this point says that once you are formulating the corporate level strategies, it's important to keep in mind available resources as well as the environmental factors which affect that organization. Okay. And finally, the corporate level strategies are concerned with the decisions regarding the of the company's information and resources between the various levels of management, right? So top down and then bottom up. All decisions regarding the flow of information within the organization are considered when formulating corporate level strategies. Okay, it's not only centered at the top. It's not only left for top level management. Even though it is done at the top, you realize that decisions from lower level managers as well as middle managers are considered, okay, in the formulation of corporate level strategies. So we can have different strategies. We can have strategies that seek to stabilize the organization, right? In a case where things are not certain, you are not sure what will happen in the near future, you may want to, as an organization, incorporate strategies that will stabilize the firm, right? You can also have strategies that seek to expand the business, that seek to expand the organization. Okay. You may also want to consider retrenchment strategy in a case where you anticipate that things are going to turn bad or things are going to become worse. Then you think about strategies that will get you out of that business, maybe into another kind of business, all right, or to to move from one maybe product to another one, or to get out of business completely. All right. And then finally, we have the combination strategy where you combine all the strategies. Okay. So we'll look at some types of strategies that align with stability, that align with expansion, retrenchment, or a combination of all of these. And the first one we will discuss is diversification. Okay. If we say diversification, it's a strategic approach which involves expanding an organization's operations or investments into new areas or new industries that are different from its current industry, right? So, for example, if the business is into the production of a particular product, what diversification is that the organization now considers entering another business, or coming up with a production of another good, or producing another kind of service. So this one involves expanding the organization's operations or investments into new areas. It could be a new product, it could be a new market, right? But that is diversification. So a new area that is different from what it is already doing. Okay. So for example, if it's in the production of maybe laptops, then it is moving into another kind of product. Okay. So we may have two types of diversification. First, the main objective of diversification is to spread risk. So you know that if you are in the production of just one product, or maybe two or three, and you diversify into other products, what it means is that you have spread the risk, so that it doesn't matter what happens with one product, you know there are others that you can fall on. Okay, so it spreads risk, it helps you to be able to spread risk, and it reduces the dependency on a single market. Okay, so it means that if you are doing laptops and you diversify into maybe the production of maybe phones or clothing, what has happened is that you are no more depending on just the market for laptops, but you also consider the market for clothes and maybe the market for phones as well. So the primary objective of diversification is to spread risk, to reduce dependency on a single market, and achieve a more balanced and stable portfolio. Okay, so we can have two types of diversification. You can have related diversification and unrelated diversification. Related diversification is a case where the organization expands into a new business area which is related to its current position. And the main objective is to leverage existing capabilities, to share resources, and create synergies. So in a related diversification, the business is expanding into an area or into a product which is related to what the business is currently doing. So even though the organization is diversifying, they are diversifying into a product or into a service that is related to what the organization is currently doing. And what this means is that the organization may not have to get a new set of resources for operations. All they have to do is make use of the resources that are already available to them. Okay. And they will be able to come up with the diversified products. So with the related diversification, you can have horizontal diversification, vertical diversification, and then market diversification, right? So an example of the diversification is where you think of a technology company that enters a new software market related to its core um, products. Okay. So for example, if you have a tech company and they already come up with softwares, right? Then you can think of other softwares which are related to what they already do. So what you'll notice is that they don't have to get new software engineers, they don't have to get new equipment. Just with what they have, they can come up with a related product. Okay, so like we said, you have horizontal diversification and then a vertical diversification, as well as a market diversification. But with related diversification, the organization is coming up with a new business that is related to its current position or its current business or its current operation. Then you have unrelated diversification. This is the opposite of the related diversification. The unrelated diversification involves entering businesses that have little or no connection to the organization's existing operations. The objective here is to spread risk and also reduce the dependence on a single industry or on the market, right? So in this case, the new product or the new service that the organization would want to enter in may not necessarily have to be related to what it is doing. Okay, so for example, in our earlier case, in the case of the software company, their new product may not necessarily have to be another software. All right, they may go into maybe the production of clothes, which has nothing to do with software, or the production of hardware, laptops, okay, which will require some new resources before they'll be able to come up with the production of laptops. So you can have unrelated diversification in the area of finances, you can have industrial, and then you can also have investment diversification. Another strategy we talk about is integration, right? Integration is a business strategy where an organization expands its operations by controlling or owning multiple stages of the production and distribution process within its industry. So here, integration requires that as an organization, they own some aspects of the production, right? You know that in production you need raw materials, then it is processed, and then you have your final product. Then after that, it is distributed to your clients. Okay. The same as service. Services are not tangible, but they also require some resources, and then you can serve your clients. With integration, what it means is that the business organization tries to own various aspects or various stages of the production. Okay, so if there are raw materials, then the business may want to own that aspect of production. Maybe they want to generate their own raw materials themselves, or they want to own the transportation of finished goods to the customers themselves, or they want to own transporting raw materials from wherever they pick it up from to their warehouse. All right. But integration requires that the business expands its operations by controlling or owning multiple stages of the production and distribution process. And the primary goal of vertical integration is to gain greater control over supply chain, to reduce costs, to improve efficiency, and potentially gain a competitive advantage on the market. We can have either a forward integration or backward integration or a full integration. So if we say that an organization has integrated, it can be a forward one, it can be backward, or it can be both the forward and the backward, which we refer to as the full integration. Okay, so forward integration is where an organization expands its operations into downstream activities in the supply chain. So, for example, a manufacturer of consumer electronics may open a retail store to sell the products directly to consumers, right? So, forward integration is focusing on the downstream. The downstream is where you are letting go of your products or where you are selling your products. Okay. So forward integration requires that, for example, if you have come up with a product, you also are in charge of selling the product to the consumer directly. Okay. So then you may want to be in charge of transporting the products, okay, from your warehouse out there to the market and selling to the consumer directly. Then we have backward integration, and in the backward integration, the organization extends its operations into upstream activities in the supply chain. The upstream activities are activities which involve how you get your raw material for production. Okay, so for example, if you have a restaurant, then the restaurant in making use of the backward integration will require that they themselves would maybe have a farm where they have their products on the farm, and then when they need the products, they quickly harvest their crops on the farm and then use those in preparing food at the restaurant. Okay. So in this case, they may want to start the farms by themselves or buy farms from people, okay? Or they may also look at food processing facilities, or they may look at how to get the products or their ingredients for the food preparation without necessarily depending on the supplier. So this is owning the supplier aspect of their business. Okay, so the backward integration focuses on acquiring the supplier aspect of the business, and then forward integration focuses on reaching your consumers directly and owning that part of the operation. Okay. Then you also have the market expansion, right? So market expansion, we have market penetration and then market development. Market penetration is a strategy that focuses on increasing market share within the organization's current market and target customer segments. Okay, so with market penetration, you don't necessarily come up with a new market. Okay, you don't identify any new market. All you do is try to increase your market share within your current market and target customer segments. Okay, and market penetration involves aggressive marketing and sales efforts to capture a larger portion of existing markets. Then you have market development, which involves entering new geographical markets and finding new customer segments for existing products or services. Okay, so you can have market development or expansion happening regionally, nationally, or internationally. All right. So market development requires that you are entering new geographical markets, all right, with your product. Then there's also the product development where the organization comes up with an entirely new product. Okay, so the organization creates and launches new products or services for their current market. And this strategy is often used to meet changing customer needs. It enhances product offerings and it also helps the organization to stay competitive, right? So, with product development, the organization is coming up with an entirely new product or service for the current market. There's also cost leadership, right? And cost leadership is a strategy where an organization aims to become the low cost producer in its industry. It allows the organization to offer competitive prices, gain market share, and potentially enjoy higher profits. Potentially is there because the fact that you are the low cost producer in the industry does not necessarily mean that you will enjoy higher profits. So there's a potential of enjoying higher profits, but it's not always the case. And achieving cost leadership often involves efficiency, improvements, economies of scale, and cost control. What this means is that to be able to um, succeed as a cost leader in the market, then your operations would have to be very efficient. You should have a very large market fairly, and you should also be able to control your cost. Okay. So the cost here, I mean your cost of production, should be able to control your cost of production so that it does not get too high. All right. So we have spoken about cost cost leadership, right? Then differentiation. Differentiation here emphasizes the creation of unique and distinct products or services that are valued by your customers. Okay. And organizations which follow this strategy often charge premium prices for their products or their services. What it means is that you're having a special product or you're having differences in your products, and you give your customers the opportunity to have some specific features that they want to see on their product. And differentiation can be achieved through a product design, right? Through the quality of your product, through branding, or through innovation. So any of these can help you to achieve differentiation on the market. And then sometimes the organization may opt for stability strategies like maintaining what is currently existing. So in the case where there's uncertainty, all right, or the market is not stable, or the environment is such that it's not a friendly one, the organization may want to consider stability strategies like maintaining the status quo or focusing on steady growth in their existing market. Okay. And when this happens, you realize that the organization will not want to try any new things. These strategies are often chosen when external conditions are uncertain or when an organization wants to consolidate its position. Okay, then it will go in for the stability strategies. Then you have the retrenchment and turnaround, which involves cost cutting or restructuring and divestment of the non-core assets to return the organization to profitability. So in a case where the organization is not doing well, there have been losses that are recorded, and it's not just once, it keeps happening and happening. Then the organization has to come up with strategies that will help with cost cutting, or they have to restructure their operations. Sometimes people lay some of the employees off, okay, in order to be able to cut down on costs. All right. And most of the times, this happens when there is financial distress or a declining performance. So, in the case of financial distress or a declining performance, organizations may pursue retrenchment and turnaround strategies so that they move from the point of non profitability to a level where they will remain profitable as an organization. Otherwise, they will get out of business. Okay. Then you can also consider global expansion as a strategy for the organization. And this could involve exporting products or establishing overseas subsidiaries, okay, or forming strategic alliances or franchising operations in foreign markets. But the idea is that you want to move from, or you want to expand from your country where you maybe started operations as an organization to other terrains. And organizations looking to expand internationally may pursue global strategies. Okay, and that's what we spoke about, that you may want to export your products, or you may want to establish subsidiaries which are overseas. Okay, or you may want to form strategic alliances, partner with organizations which are abroad, or franchise your operations in foreign markets. So, looking at all of these strategies, we now move on to the Ansoff matrix, which is a strategic planning tool that helps businesses identify growth opportunities by aligning products and markets, right? The product is what the organization develops or comes up with. So it can be a product or a service. And the market are the people who patronize the product or the service. Okay. So the Ansoff matrix, what it does is it helps businesses, or it helps organizations to identify growth opportunities by aligning the product or the service to the market. And it focuses on growth potential versus its associated risks. Okay. So the main components of the Ansoff matrix, we have explained each of the components here. The main components are the market penetration, product development, market development, and then diversification. We said market penetration focuses on increasing market share in existing markets with your existing products. And you achieve this through aggressive marketing or pricing strategies. So, market penetration requires an existing market and an existing product. And you achieve market penetration through aggressive marketing or pricing strategies. Then you have product development, which involves introducing new products to your existing market. Okay, so if you look at your existing markets, or people who now are currently buying from you, product development requires that you introduce new products to these customers, or to these people who purchase from you. Okay, so an example of the product development, you have technology upgrades or launching variations of existing products, and we see how people are able to give us new upgrades. Most of the times, I think it's annually, every year, there's an updated version of the product. That is product development. Then you have market development, which involves entering new markets with existing products. Okay, so for example, expanding geographically or targeting new customer segments. Then you have diversification. Diversification is where you develop new products for new markets, like diversifying into unrelated industries or creating entirely new product lines. Okay, so basically these are the components of the Ansoff matrix, and it helps you to know and analyze the level of risk, right? So if you look at the components here, you have market penetration, you have product development, you have market development, and then diversification, right? On the horizontal, axis, you have your existing product and then your new product. And then on the vertical, you have new markets and existing markets. So for example, if we pick okay, so let me talk about the level of risk. The level of risk from the vertical axis shows that where you have your existing market, right, it's fairly a low risk. And then as you venture into new markets, it becomes a high risk. With the products as well, where you have your existing product, the level of risk is low. But as you move towards your new products, or if when you move towards coming up with new products, then the risk becomes high. Okay, so with this understanding, we can analyze. If we pick market penetration, you realize that market penetration focuses on existing products along with existing markets. So once you have an existing market and an existing product, you realize that the level of risk is very low. Okay, so the level of risk is low for both the markets and then the products. But when you pick product development, okay, the product development, you notice that for existing markets, the level of risk is low. But for new products, right? For new products, the level of risk is low. But for existing markets, sorry. So for product development, you have a combination of an existing market and then a new product. For the product development, the fact that it's an existing market makes it a low risk for the market. But because you are introducing a new product, the risk is high. Okay. Then when we look at market development, because you are focusing on an existing product, the risk is low, right, for an existing product. But because of the fact that you are focusing on a new market where you don't know what is likely to happen in that new market, then the risk for the new market is high. Okay, so for market development, the existing product, you have a low risk, but for new markets, you have a high risk because you don't know how things are likely to turn out. And then for diversification, where you are focusing on entirely new products and an entirely new market, the risk is high for both the product and the market, right? So as a business, depending on what you want to do, if it's market penetration, product development, market development, and diversification, you have an idea the level of risk that you are likely to face, so you are able to strategize well, right? Okay. Then we have Porter's generic strategies. And this is a framework that helps to achieve competitive advantage through three primary strategies. So it looks at cost leadership, differentiation, and focus. So we have explained already that cost leadership is where the organization focuses on achieving the lowest production or operational costs in the industry. And then you have differentiation, where the focus is on offering unique products or services that justify a premium price. Then you have focus strategy, which looks at targeting a specific market segment through either cost focus or the differentiation focus. So we look at the Porter's generic strategies here in the diagram, right? So you have costs here, right? And then you have differentiation here. So on the vertical, you have costs and differentiation. Okay. And this framework helps you to know what makes your organization strong, right? So your costs and your differentiation. And then vertically, you have the entire organization or the entire business on the upper horizontal axis. And then on the lower horizontal, you have a market segment. So this is just a segment of your market. So what part of the market is being targeted is what you have here. Is it the entire market or just a segment of the market? So with cost leadership, the strategy is to be the most competitive company in cost in the entire market, right? And then with differentiation, the strategy is to be a distinctive company recognized for its uniqueness, quality, or personality. So you have this and that. The organization may focus on costs or on differentiation. Okay. And then on the segment, which is a focus on just one uh, segment of the business, you can have the cost focus or differentiation focus. So what this means is that the entire organization may not really be interested in being the cost leader, but just for a particular market or just for a particular product, they would want to be the cost leaders. And so this is what you refer to as the cost focus. That's what you call the cost focus. And it requires that the company is competitive in cost in a particular product. And the same applies to the differentiation product. What it means is that for a particular market segment, the organization would want to differentiate products or the market. Okay. So basically, these are the strategies, the Porter's generic strategies. You have cost differentiation and then cost focus, differentiation focus. All right. So the cost requires that the entire organization becomes the cost leader. All right. And then differentiation requires that the entire organization has differentiated its products. Okay. Then cost focus and differentiation focus applies to just a segment of the market, not the entire organization. Okay. I believe this is clear. Let's answer all your questions when we meet in class. So you can note the questions down. When we meet, we can discuss the questions thoroughly. Okay. So our discussion or your class activity is to identify which strategy you would recommend for your startup in a highly competitive industry and why. Okay. And you'll be presenting this in class. Okay. So which strategy would you recommend for your startup in a highly competitive industry and why. Thank you very much. Let's meet in class to discuss further.